We distinguish between investing and speculating. We are investors, not speculators. And as investors, we build portfolios that are globally diversified and that hold literally thousands of securities. We limit portfolio adjustments or the need to buy and sell. We don't need to change our portfolios in reaction to the daily news. Very, very important. Speculators, on the other hand, tend to hold concentrated portfolios with possibly just a few securities. They may buy and sell daily and regularly react to news reports. We believe stock picking and trying to time the market to get in before it goes up and to get out before it goes down is also speculating. The academic evidence suggests that stock picking and market timing fail in the long run and that they actually detract from portfolio performance. So there is no question that investors increase their odds of success tremendously by sticking to an investment rather than a speculative strategy. Investing can be an emotional roller coaster ride, and we believe that we can smooth out the ride by understanding the four basic economic environments that exist. One economic environment is prosperity, when the economy and the financial markets are doing well, unemployment is low, and there's a general feeling of well-being. Much of the 1980s and 1990s were prosperous, and stocks perform well during that time. Another economic environment is inflationary. During inflationary periods like the 1970s, prices rise, and cash tends to perform well during these periods. The third economic environment is recession. Recessions generally follow periods of prosperity or inflation, and they cool the economy. And if they are mild, they are healthy. And bonds tend to perform well during recessions. A fourth economic environment is deflationary, the opposite of inflationary periods. And in deflationary periods, prices generally decline. And deflation can be troubling because it can lead to a depression like the one we had in the 1930s. When we build portfolios, we want to have different asset classes and investments that are going to prosper in all these economic environments. We don't ever know when they're coming, and we don't want to try to time these economic environments, but we build portfolios that will prosper when they arrive. And over the last 100 years or so, periods of prosperity have dominated, so we tend to build portfolios to emphasize that. But as 2008 showed us, things can turn on a dime and get very scary quickly. And that's why we want to understand the different economic environments and build diversified portfolios.